Hi, this is Paul from globaltradingsoftware.com, and this is a day trading tutorial for SPY traders. So I'm using the ThinkorSwim platform here. I'm using the XBRAT Range Breakout Trading Indicator, which identifies not only the opening range for SPY, but also gives you the bias. So whether you're looking for longs or shorts. So if it's green, you're looking for a long. If it's yellow, amber in some cases, it's neutral, so you just wouldn't trade, and if it's red, you're looking for the shorts. But we have a new strategy with this as well now, which we do on our auto trader, which works very well. So I want to talk about the three strategies here. This is a week in SPY, very recently in August 2022. I'm going to go from Monday all the way through to Friday and talk about those trades. So first of all, we're on the 15-minute time frame. So that first 15 minutes is very critical. It's the highest volatility, and in most cases it sets the trend for the day. But there are times when it reverses, and we need to understand that, but also times when it comes back through that range, and we've got some great examples in this week. So the first, on the Monday, we get a rejection of these lows, the candle forms, and we get what's called a bullish bias. So we're only looking for the longs. So in reality, when we're trading futures on this, we'll look for 3 ticks, 2 to 3 ticks above that range, and we look for that long entry. So that range high there was 395.93, and that high there was 396.04. So we got tiptoed into this one. The stop is just below there. We'd get taken out, and that is a loser. Not every trading strategy, in fact there's no trading strategy that has a 100% win rate. So then, and this just basically dictates the day. You can see how rangy this is. It never really goes. So if I get a loser, that's it, I'm gone. I don't trade for the rest of the day. Tuesday, come back confident. We get the range defined, it's red. We're looking for the short range breakout, stop above the top there, entry here, and it goes all the way using the manager all the way into the close, take the profit there. So you can see the manager ribbon here, again, one of the only trade management indicator on the market that gives you and understands behavior. This is very simple. You're in the trade. As long as that ribbon remains red, you stay short all the way into the close and just close out your trade. Next day we gap up. First 15 minutes is defined. We then get that opening range with the bias of green. We're looking for the long breakout. We're long. We don't panic on these pullbacks. These pullbacks, you see these blue dots on the candles here? This means it's lower than average volume. So we're not really concerned when that pulls back against us. Remember, we're in this for the longer term. We're trying to get those runners into the end of the session. The manager that we use here still remains green, and then we get this massive burst into the end of the session and we close out at profit. Now this is the next bit that I'm really interested in here, because occasionally we get data that comes out and we get reversals, and we look for reversals in the first 5 candles. So in this case we are defined green, we're looking for a breakout, but we get data that comes out usually at 9:45, and that sends us the opposite way. Now with a range breakout to the bias, we always use the manager to manage the trades. If we're going to reversals, we do 20, 30, 40, 50 ticks, and that's it. We have a set target in mind and we just go for it, hit the target and get out. So that reversal has to happen within the first 5 candles. Usually, most of the time, it's on data. So even though we're bullish bias here and we're looking for that long breakout, we also have that reversal on there because we've got data coming up and we get that 50 tick move. Okay, then this is the next strategy. We get what's called a continuation trade. So the price action comes back through the opening range. The opening range at this point was yellow, it was neutral. If it had come back through there, we wouldn't be putting an order on. But this candle closed in the range. The range was green, so we put an order to go long above the opening range. There we go, all the way into the close, take profit. This is the Friday. Simpler one here. We get the opening range. The bias is coloured in green. We're only looking for the long. We get in long and we go long all the way into the end of the session because the manager is still green. Let's just have a look at, I'll see if I can find a couple more examples. So this, on the next week, we see here, we got a neutral candle, so we don't trade, okay? That's a Monday again. This is starting to see a bit of a pattern here. On the Tuesday, we get a red. We're looking for the short. Usually when we've gone through 20 ticks, we make it break even on the auto trader. So this one would have been a break even trade. 1, 2, 3, 4, 5 candles. Breaks out the top. Remember, we're looking for those reversals. So we're bearish bias here, but we'll reverse. On the fourth candle here that closes back in the range is still red. We're still within our parameters, first 5 candles. We put the long order on for the reversal, and there it goes all the way up. And again, looking for that 50 tick scalp, out you get. Following day, we get bullish bias on the opening range. We go long, the manager stays green all the way into the close here. And this is the Thursday, very rangy day, not very good. We get the tiptoe trigger in here, take a loss, don't trade for the rest of the day. So you can see 1 out of those 4 days may get a loss, but the rest are so far winners. We get this on a Friday. We get the opening range. It's the bias is red. So again, we're looking for a data surge to push us on the reversal, or we go red with a breakout to the downside. In this case, the reversal happened on candle 2, and we take that 50 tick scalp. Once we've taken the reversal, though, we'd never trade the continuation for the rest of the day unless we are, really strong. So at this point here, we come through into the range. We get a good close here into the range. The range is red. Put a short order on here, it never triggers, okay? We'd never do a reversal again, though, during the rest of the day. So then the following week, very, very simple. We get to break even trade on the Monday. We get a Tuesday, we get a bearish bias. We go short, never takes a stop out, but we're about break even, really. Nothing really exciting that day. The same with the following day. We get the nice long breakout here on this day, on the Thursday. Again, we'll break even. 1, 2, 3, 4, 5. So we don't take the reversal in this point here because it's too many candles. Friday, long all the way into the close. And then, as you can see, the pattern just continues. This day here, Tuesday, we get a neutral opening range. We don't trade, okay? We can, however, trade when it turns green, and we get that continuation trade, and it comes through and takes the long. And then so on and so forth. So it's a very simple strategy. It keeps your charts very, very clean. Defines the range, but not only that, it defines the bias for the range. Then you've got 3 strategies. You've got that opening range strategy. So when you break out in the direction of the bias, you take that after 20 ticks, you put it at break even, let it run, let the manager tell you when. If that ribbon turns to red, if you're long, you take it out. And then the next one is if you're defined red, but within the first 5 candles, it breaks out to the upside, you're getting that reversal. And usually that's that catalyst for that reversal is data. So you need to put a trade on both ways. So you'll put a long and a short on either side of that range. And then finally, that continuation trade, if we just go back and look for that example, it doesn't happen all the time, but when it does, it's very, very powerful. So let's just go back. So in this point here, we can see we had the reversal, we came back through, and then the bias is green when this candle closes. We put that order on to go long, and that's what we call a continuation trade. So 3 strategies, 1 trading indicator to give you that. But then that second indicator is that trade management. That tells you not to panic when this goes sideways. It's staying green. The dots below the candles are blue. Don't panic. Take it into there. So combining them both together, the range breakout and the manager gives you that cradle to grave. So you've got the signal, you've got 3 strategies, and then the grave part is actually that management. And buying these 2 together as a cradle to grave bundle gives you around about 20% discount. So check out that links below for the cradle to grave range breakout. This is the ThinkorSwim platform version, but there are lots of other platforms available. Very, very simple strategy for trading SPY.